Just moments ago, a stunning development has shaken the global financial community. The Iraqi dinar, long discussed in currency revaluation circles, has reportedly surged to a live value of $3.47 to the US dollar. This figure, if sustained and verified, represents one of the most dramatic currency adjustments in modern financial history. Market screens across currency trading desks are lighting up as traders, analysts, and policymakers scramble to understand the scope and potential impact of this event. The announcement has already triggered intense discussions on trading floors in Dubai, London, and New York, with speculation running high over whether this is the result of a long-planned policy shift or a sudden reaction to external pressures. The revaluation, according to initial reports coming from currency tracking services and on-the-ground sources in Baghdad, was implemented in a manner that suggests months of behind-the-scenes preparation. The Central Bank of Iraq, which has remained largely silent in recent weeks despite mounting speculation, has yet to issue a formal public statement confirming the move. However, multiple regional exchange houses are already reporting transactions at the new rate. That operational reality is adding fuel to the belief that this is not a rumor but an active, functioning change in the currency's market standing. The speed at which this rate has appeared is catching even seasoned observers off guard. In the days leading up to this moment, subtle shifts in Iraq's financial posture were becoming harder to ignore. Quiet meetings between Iraqi financial officials and representatives from the International Monetary Fund, the World Bank, and several Gulf-based sovereign wealth funds were reported. Although official agendas were never disclosed, insiders suggested that the discussions centered on monetary stability, currency reform, and aligning Iraq's financial systems with broader international standards. These whispers now appear to have been early signals of an imminent revaluation. The magnitude of today's reported rate adjustment suggests an extraordinary level of confidence within Iraq's leadership about the country's economic resilience, oil production capacity, and political stability moving forward. For those who have followed the Iraqi dinar story for years, this moment is charged with both excitement and caution. The dinar has been pegged at relatively low values for decades, with occasional fluctuations tied to oil prices and political events. Over time, investors and speculators have accumulated dinar holdings in the hope of a significant revaluation, despite repeated warnings from financial authorities that such expectations were largely speculative. Now, with live exchange rates displaying this remarkable 3.47 figure, the global conversation is shifting rapidly. Financial analysts are already recalculating Iraq's GDP in US dollar terms, and the implications for trade, foreign investment, and debt servicing are immense. This development could potentially transform Iraq's purchasing power on the world stage. A higher value currency means greater import capacity and reduced costs for essential goods, but it also presents challenges. Domestic producers may face increased competition from cheaper foreign imports, and the government will have to carefully manage the transition to prevent inflationary spikes or market instability. The banking sector, in particular, will play a critical role in executing this shift smoothly. Commercial banks are reportedly rushing to update their systems to reflect the new rate, while ATMs and online banking portals are undergoing urgent recalibration to prevent transaction errors. Internationally, the reaction is mixed but intense. In Washington, the U.S. Treasury is closely monitoring the situation, given the deep financial and political ties between the United States and Iraq. In the Gulf states, markets are reacting with a blend of surprise and strategic calculation, as a stronger Iraqi dinar could alter regional trade balances. In Asia, particularly in China and South Korea, where Iraq supplies significant quantities of oil, the shift could affect contract pricing and payment structures. The European Union, too, will be assessing how the revaluation impacts its business interests in Iraq's energy and infrastructure sectors. Currency traders are treating the situation with extreme caution. The foreign exchange market is notorious for rapid corrections, and while the 3.47 rate is being reported in live transactions, some experts warn that it could be subject to temporary volatility before settling at a sustainable level. Others argue that such a precise and significant adjustment would be unlikely unless Iraq's central bank had already secured major foreign reserves and stabilization agreements with international partners. This suggests that, behind the scenes, the revaluation may have been coordinated with key global financial institutions to ensure its durability. Inside Iraq, the public response is a mix of disbelief and guarded optimism. For ordinary citizens, the immediate question is what this means for wages, prices, and savings. A higher value dinar could stretch household incomes further when purchasing imported goods, but the transition period could bring pricing confusion and potential opportunism in retail markets. Merchants may need official guidance on recalculating costs, and government ministries will have to work swiftly to update contracts, payment systems, and public sector salaries. The social impact could be profound if the change leads to a noticeable improvement in living standards. Politically, this move could significantly strengthen the standing of Iraq's leadership. A successful revaluation would project an image of economic competence and confidence, both domestically and internationally. It could also enhance Iraq's leverage in regional negotiations and its attractiveness to foreign investors seeking stability and profitability. However, political opponents may seize on any missteps during the transition to criticize the government's preparedness or motives. The timing of this move will inevitably be scrutinized for its alignment with Iraq's internal political calendar and any broader geopolitical strategies at play. Energy markets are another arena likely to feel the ripple effects. Iraq is one of the world's leading oil producers, and its revenues are overwhelmingly tied to crude exports priced in US dollars. A stronger dinar means that Iraq's dollar-denominated oil sales will translate into higher domestic value, potentially boosting budget surpluses and enabling larger investments in infrastructure, healthcare, and education. At the same time, the government will need to navigate the implications for existing oil contracts, many of which are structured on fixed currency terms. Renegotiations may be necessary to reflect the new reality, which could create friction with some partners. International aid and debt repayment agreements may also need to be revisited. For creditors, a stronger dinar could mean faster repayment schedules or increased returns on outstanding loans. For Iraq, it could open doors to improved credit ratings and lower borrowing costs, further reinforcing economic growth potential. Global development agencies will likely view the move as a signal that Iraq is ready to take on a larger role in the international economy, though they will remain watchful for any destabilizing aftershocks. The revaluation also raises complex questions about the role of the US dollar in Iraq's domestic economy. For years, the dollar has been a dominant presence in major transactions, a legacy of post-2003 economic policy and global trade norms. If the dinar's strength is sustained, it could gradually reduce dollar dependence, shifting more transactions into local currency and fostering greater monetary sovereignty. Such a shift would carry symbolic and practical weight, reinforcing national identity while also insulating Iraq from certain external currency fluctuations. For global investors who have long held dinar positions, this moment is both vindication and a test. Those who invested heavily on the belief that such a revaluation was possible may now be in a position to reap substantial gains. However, they will also face decisions about whether to cash out immediately or hold in anticipation of further appreciation. Tax implications, repatriation rules, and currency conversion logistics will all factor into those decisions, making this a complex and